So the stock market has been very good this year to most stocks. The S&P 500 is up about 17%. A disproportional amount of that is the big tech companies that make up a lot of the index. But you have to kind of hunt for stocks that have not had a great 2023. If you're looking at stocks that are down 20% or more, it can be tough to find stocks that aren't beaten down like that for really good reasons and you should stay away from. So Tyler and I each found one that we particularly like right now that is down by 20% or more in 2023 that we would pull the trigger on right now. So Tyler is going to talk about one that used to be one of the biggest REITs in the country. I think it might still be one of the top few. But its yield has gone up tremendously and it's been beaten down. Tyler, which one are you looking at?
Yeah, I'm going to couch your statement earlier and say I'm very intrigued by this. I might have to do some more digging because before I really pull the trigger on it. But one that looks intriguing to me right now is Crown Castle. It's an infrastructure REIT that focuses mostly on cell towers, but as well as small cell nodes, which is kind of the we'll call them mini towers that are needed for deployment of 5G in cities in urban areas where you need a lot more capacity for all of this data transfer. It's kind of been the big, we'll call it the big initiative at the company in the spending plan over the past several years is building out this network of small cell nodes, basically saying, look, if 5G is really the thing that we think it's going to be, that's going to enable things like the Internet of Things, it's going to enable autonomous driving, a lot of the things that we have been kind of purporting for a long time as the big catalysts of data growth globally, these small cell nodes are going to be absolutely necessary. They've been building it out probably early because the returns on it have been not great compared to the traditional cell tower business. And I think that's a lot of the reason why the stock has been hurt so particularly bad is because the returns don't look as good because they have to invest so much into this new development. With that said, it currently trades with a dividend yield of 6.4%. There's, some other headwinds too. The merger between Sprint and T-Mobile is causing some issues with what's called churn. Basically, like they're both looking at being like, well, we don't need two pieces of equipment on the tower. We just need one because we're one company now. Things like that. That over the next couple of years is going to be a headwind. And obviously, higher interest rates means that development is going to be harder to come across, harder to finance. So this isn't a perfect layup, but at a 6.4% dividend yield, it looks more attractive than a lot of the other communications REITs like American Tower or SBA Communications, which have much, much lower yields, but they're kind of facing the same outcomes. So I think the market is maybe pricing this one a little bit more appropriately to where we are in interest rate environment relative to a lot of other REITs right now.
Yeah, and another one that's kind of, I guess, been repriced by the market. It's the business hasn't done well, but there are good reasons for it. Most of it seems to be temporary, and the price seems to be right. And it's Outfront Media. Ticker symbol is OUT, out. There's two sides to Outfront's business. They are an out-of-home advertising company. They're technically a real estate investment trust, but their business is a little bit different than most. They operate billboard advertising solutions all over the country, and they're also one of the biggest players in transit system advertising. If you're ever on the New York subway and see one of those ads in the tunnels, that's good chance Outfront put it there. So the environment for advertising has not been a great one, and not just recently. The COVID pandemic really caused their business to grind to a halt. No one was spending money on billboard advertisements when no one was driving. No one was spending money on transit system advertising when people weren't commuting to work. The transit system business never really came back to what it was pre-COVID. You have a lot more people working remotely right now. And now, on both sides of the business, companies are hesitant to spend money on advertising with fears of a recession, with inflation going on, with just a general decline in consumer discretionary spending. It's not a great environment for advertising. That's reflected in the numbers. Outfront's revenue was up 4% year over year in the last quarter. Most of that was on the billboard side, not the transit side. Its profitability is down because of rising rates. It's has a lot of debt that is interest rate sensitive. Um, so FFO, it's still a profitable business. Funds from operation was down 16% year over year, still making enough to cover its dividend. And because the stock has been beaten down, it's down roughly 50% from its 52-week high. The stock actually pays an 11.5% dividend that's covered by the money it's making. Now, no company that has an 11.5% dividend is without risk. We've seen that in a few stocks we follow, but I think that there is a lot of value in this name long term, and it's one that I own. I haven't sold any of it, and I might add to it if this valuation holds. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.